Hey everyone, welcome back to Stocks Telegraph, the channel where we break down the latest stock news, trends, and analysis to keep you in the loop on everything happening in the market. If you're new here, hit that subscribe button and turn on notifications so you never miss an update. All right, today we're diving into NIO Incorporated. That's NIO, the Chinese electric vehicle company that's been making some serious noise in the EV world. Now, despite a few bumps along the way, NIO is still showing signs of solid growth. But the big question is, should investors be watching this stock closely, or is it time to move on? Well, we've got a lot to break down, so grab your favorite drink, kick back, and let's get into it. Let's start with the basics. Right now, NIO stock is sitting at $4.41 per share. Now, before you panic, that's a 42% drop from its 52-week high, which, that's a pretty big drop. Hold on, don't write it off just yet. Analysts are still pretty optimistic. The average target price for NIO right now is around $6.01 per share, which means there's a 36% upside from where it's sitting today. That's a decent potential return if things go right. Also, analysts have given NIO a recommendation score of 2.16, which is pretty close to a buy. So if you're thinking about adding NIO to your portfolio, it's definitely one to keep an eye on. Now let's talk numbers. Over the last 12 months, NIO's gross margin has been sitting at 8.65%. And honestly, that's not exactly stellar, but here's the thing, it's improving, so there's potential there. We're also seeing some good growth in their earnings per share. This year, they've posted a 13.32% increase, and next year, they're projected to grow by 21.49%. That's pretty solid, especially in the EV market, where competition is fierce. However, NIO is still struggling with one big thing: profit. They're projecting to break even by 2026, but right now, they're not quite there yet. So if you're expecting immediate profits, NIO might not be your dream stock just yet. Now let's talk about the good stuff, growth. NIO just wrapped up a killer December, delivering over 31,000 vehicles. That's a 72.9% increase year over year. Not bad, right? And overall, in 2024, they delivered nearly 222,000 cars, which is a 38.7% increase compared to 2023. They're clearly scaling up production, and that's a huge win for the company. And they're not stopping anytime soon. At NIO Day 2024, they unveiled the ET9, a smart electric executive car. And guess what? Deliveries for this bad boy are scheduled to start in March 2025. But wait, there's more. They're also launching a new high-end brand called Firefly, set to drop in April 2025. So the lineup is expanding, and that could mean big things moving forward. Speaking of new models, NIO's got something else up their sleeve, the Onvo brand. This one launched in May 2024, and it's all about hitting the mass market with more affordable EV options. Take the Onvo L60, for example. It's priced as low as $22,000, making it a serious competitor to Tesla's Model Y. And it's not just talk. By December 2024, the Onvo L60 had already surpassed 20,000 deliveries. That shows there's definitely demand for more affordable EVs in the market, and NIO's capitalizing on it. One more thing NIO's doing differently is their battery subscription service. Instead of having to wait hours for a charge, you can just swap out your battery. This is a game changer, especially when you think about how long it takes to charge a regular EV. Plus, by offering battery swapping, they're also tackling the high costs of EV batteries, which is another win in my book. This could be one of the key factors that sets NIO apart from other EV companies, especially as the competition in the EV space keeps heating up. All right, let's talk about the not-so-great stuff. Over the past year, NIO's stock has been down 43%. Yeah, it's a bit rough. They've had to cut their delivery guidance a couple of times in 2024, and their third quarter results were pretty underwhelming. Revenues were down 2% year over year, and they posted a loss of $0.31 per share. Definitely not ideal, but they're still showing growth, and the long-term outlook for 2025 is looking promising. Looking ahead, analysts are expecting a 25% growth rate for EV sales in 2025, and they predict that EV penetration in China could hit 60%. If NIO can ramp up production and meet their goals with Onvo and Firefly, 2025 could be a breakout year for them. Fingers crossed. So is NIO a buy right now? Honestly, it's a bit of a gamble. The stock's trading at a relatively low price-to-sales ratio, and with their strong pipeline of new models coming out, There could be some serious upside if they hit their delivery targets. But don't get too comfortable. There's still a lot of risk here, especially considering their current financial struggles. So what do you think? Is NIO worth the risk at these levels? Or is it time to move on? Drop your thoughts in the comments below. We'd love to hear from you. And if you enjoyed the video, don't forget to hit that like button, subscribe, and ring the bell so you never miss a market update. This is Stocks Telegraph, and we'll see you in the next one.